Good morning, everybody. I'll keep it brief and just touch on the group highlights and then quickly on the below rail and the above rail business. Overall, as you know, revenue's down about 320 million, predominantly reflecting the items we noted last year, which includes the sale of the Redbank business, or Redbank facility rather, for 43 million, and lower performance in the freight business of about 180, which reflects the disposal of the CRT business last year and the wind back of the TSC contracts. Underlying EBIT followed in line, down 9% against the previous year, off 99 million. Included in that, a couple of one-offs, 20 million for the Q&I bad debt, 16 million for a share gift to employees for hitting targets last year of 75%, and about 24 million in redundancy costs, which we've taken above the line. On a normalised basis, removing Redbank, CRT and the TSC adjustments, revenue was off 3%, EBIT was actually up 2% or 19 million on the year. Final dividend, 13.3 cents, paid 100% payout ratio on the underlying EBIT numbers. As you know, the statutory NPAT included a $500+ million impairment for predominantly Aquila, but also further impairments on the fleet as we continue to drive the productivity and efficiencies through the rolling stock. Big delivery for the year was the transformation program. Again, another 130 odd million delivered during the year through both labour efficiency and asset efficiency, and we're targeting a further 250 million of cost out for the business over the next 2 years. Well advanced on that program. You may have noticed we announced a significant restructure in the operations group a few weeks ago, which will see some 300 heads disappear from that business in the next month to 2 months, with further restructuring to occur over the next couple of years. Turning to free cash flow, despite the EBITDA being down, is up 35% year on the year, predominantly reflecting the significant reduction in the CapEx spend as the below rail growth projects come to completion, and also continued improvements in capital allocation across the rest of the business. And we expect to see significant improvement in the free cash flow next year and the year after that, again reflecting a reduction in forecast CapEx, plus the disposal of the Moorebank investment that we had to queue a couple of weeks ago. Just quickly touching on the above rail business, key driver in the above rail business was the freight business I've talked about. Coal was actually only off 3% on stable volumes in the second half of the year, so that's still performing very well. And iron ore volumes are consistent with the guidance we gave last year. In terms of the below rail business, again, a record volume this year, up marginally on last year's numbers, and a 5% increase in EBIT. Resolution of UT4, we thought we'd got that this year. Unfortunately, Glencore put a submission in on the death knell, which will just extend the process by a couple of months, but we believe there is little substance to Glencore's submission, so hopefully QCA will move through that fairly quickly.